Let's talk about public debt. It does look strong, but private debt, well, doesn't look so good. Public debt, which are bonds that trade on the public market, is looking rather strong based on the small yield margin between investment grade and speculative grade securities compared with the risk-free government debt. That's what you really look at. Risk-free government debt, there's no risk on that. So you can compare other things to that risk-free debt.
And if you look in September, $207 billion of corporate bonds were issued, and that's the fifth highest monthly amount on record. Year-to-date returns for those holding public corporate bonds, well, that stands between 7 to 8%. So they've actually done decently well as, rates have pulled back a little bit.
But private debt, on the other hand, is starting to have issues as companies such as Tricolor Holdings, which is a lender to individuals with low credit ratings, filed for Chapter 7 bankruptcy in September. The debt holders, well, they may get something, but when a company files Chapter 7 bankruptcy, the government receives their money first, along with, no surprise here, the attorneys, and then, if there's anything left, then we'll give it to the debt holders, the bond holders, and then equity holders. So I doubt the bond holders will get anything here, or the debt, because they're not bonds when you have private equity, it's just debt.
Yeah, it's just you borrowed money. Yeah, you didn't own a bondholder. So I don't know. We'll see. And then also, too, when you look at last month, an auto parts company called First Brands, well, they filed for Chapter 11 bankruptcy as they had $6 billion of leveraged loans outstandings. I mean, we point this out because this could be the beginning of an avalanche of defaults in private credit. As I believe if the economy continues to slow down, these products will have some major problems. And the big thing we say here is hopefully you weren't sold anything that deals with private debt, equity, or real estate by your broker, because the concern is if there is an avalanche of declines, you won't be able to get out. You're stuck. You're trapped until they say you can get out. And the thing that you look at with this private credit is there are going to be a lot of different loans that were made. So, it wouldn't go to zero, but that 8% yield that you thought was promised because it was a loan and it was safe. And obviously they didn't say it was guaranteed, but maybe you were sold that it was safe. That is not maybe going to come to fruition if you're starting to see these companies file bankruptcy, because now they're not paying. Now they're not getting their principal back either. That's the big concern. If that happens, there's no principal left to be repaid. That's where these could really run into issues. Not to mention, we talked about in private credit, a lot of times the way that they're getting higher yields is through leverage.
Right. And I do want to mention also, too, I watch CNBC in the morning, see what's going on around the world. And yesterday morning, Friday, they were talking about, and I forget the name of I think it was private debt, but they were down, I think it was like 20%. So they mentioned another company that's having trouble with private debt. I think, again, we talked about, I think this tip of the iceberg, especially if we do see a slowdown in the economy, which we think we'll see, these are going to start having problems. Not just private debt, private equity, and private real estate as well. I think people are going to be very disappointed they tied their money into that.
When you kind of always look at it, again, if it sounds too good to be true, it probably is. With the 10-year yield around 4 and you're in a debt instrument paying 8, that's not risk-free.
No.
The risk-free rate is 4. Right. So you're doubling the risk-free rate. There is risk associated with that product.
And I'm not sure if you can say that or not, but I kind of feel like, okay, if 4% is risk-free and you're getting 8%, are you doubling the risk? Probably not quite that easy to say that, but you are definitely having a much higher risk than that 4%.
Oh, absolutely. And I was going to say the other thing, too, on the corporate bonds is it is interesting to kind of see the narrow spread, as you said, right now between treasuries and corporate bonds. And generally, I like to lean, I think, it's kind of funny. We don't buy bonds. We haven't bought bonds in so many years. It was about 2007. But ideally, I would look at a corporate bond because you get a little bit higher yield, especially in a tax-deferred vehicle. You're not paying the interest tax on that or the income tax on the interest. But now with the spread so tight between treasuries and corporate bonds, I mean, sometimes the treasuries might be better because especially here in our lovely state of California where we have such high tax rates, well, you're getting the treasury state tax free, where if you have a corporate bond, you're paying income tax in California on that bond. So, if you're looking at these different rates and stuff, and it is a narrow spread, if you make high income here in California, the treasury might be a better rate for you than a corporate bond.